All right, everybody. Well, welcome to our module on life insurance. Hopefully, this will be a very uh, educational section. It is something that is very challenging to discuss, obviously, because as you think about life insurance, there's one aspect that a lot of people don't want to deal with, and that is the end of their own life. And obviously, this is a topic that for some financial advisors is something that they try to steer away from. But hopefully, you'll have a better understanding of life insurance at the end of this module, at least something to start thinking about when you get ready to leave the university. Maybe you're starting to thinking about getting married, and all of the dynamics of your life changing obviously is going to now be put into perspective as you start to think about what happens if, and then, we need to start thinking about those type of things. Okay, so life insurance. So basically, it is the idea that you are transferring risk. Okay, so that is the fundamental purpose of life insurance. And what risk are we transferring? Well, we're transferring premature death. Okay, if we live to be, as we live to be living longer and older, our financial assets are ideally going to increase that will supply us enough means to be able to live off those financial assets, whether it's our retirement accounts or whatever. Excuse me. But what if we were to die, let's say, 10 years from now? Well, we may not have accumulated enough financial assets, but yet we may have still responsibilities, our spouse, perhaps kids, that we really want to make sure that we're taking care of. So, life insurance is a form of insurance that provides a payment to a specified beneficiary. In most cases, that is going to be your spouse, a significant other, your children, when you die. Okay. And what you're doing is you're going to be paying a premium to a life insurance company, and they're going to then provide that whatever that amount is, whatever that a death benefit is. Okay. And as I mentioned, kind of in the introduction, there is huge psychological uh, challenges with life insurance because, again, you're talking about your own mortality. You're talking about the financial security of your loved ones. You're trying to think, 20, 30, 40, 50 years down the road. And all of those things are challenging to do. So there are some things that we have to deal with. Okay. So, role of life insurance companies. So, what are they doing? They are acting as an intermediary on our behalf. So, we're paying them a premium, and they are then going to pay out a benefit if we die within the term of our life insurance policy. And we're going to get into a little bit about the fact that there are different ways to structure life insurance in just a moment. But we're paying a premium, and then if we die during the term of our contract, they will pay out a specified amount. So when you think about this, we could make two or three payments, premium payments, and the life insurance company, and we die, they may have to pay out a significant amount of money, and we only paid in a very small amount. A lot of life insurance contracts, the individual will pay all of the premiums and never use it. And we'll talk a little bit about how that works. So there are three main parties to an insurance contract. There is you, who is going to be the owner of the contract. Then there's the insured. In many cases, that is you as well, but that doesn't have to be the case. I may own a policy on my spouse. So the spouse is the one who's insured, but I'm the one that own it. And then the beneficiary is the one who's going to receive any proceeds from the life insurance upon the event of the insured dying. Okay, so big question: should you buy life insurance? Well, we need to be thinking about where we are in our financial lives. Okay, as many of us, we are. You're gonna graduate college. You're gonna start a job, and as soon as you start to create a need for future payments, right? Debt is typically a requirement to make future payments. A spouse, in many cases, requires you to make future payments, right, to be able to support the spouse. Once you have children, obviously now you have future payments. So anytime and then there may be those may be more obligations, but you might also have um, desired future obligations. So maybe you want to give back to K-State or any other university that you may attend, and you say, look, I would love to leave, $100,000 to my university. Well, if that's the case, then there is now a future obligation. And if you have those, then there is risk that you may die before being able to do that. Okay. So we want to see that as we go through our financial life cycle, we're going to see aspects of our accumulation to where we're still needing life insurance, right? So our assets continue to go up. And then at some point we're going to reach a peak, and this is probably going to be hopefully at some point where we retire, and then our assets will slowly start to decline because we're using those assets. Okay. Now, up until the point that we have sufficient assets to live off of, right, this kind of peak area, we are probably needing to make sure that we are covered should we die up to this point in our life. And so it is important to make sure that we have coverage through that time. Now, if you're in the, let's say you're 31 years old and you sell a tech company for hundreds of millions of dollars, well, you probably don't need life insurance. And as you age, you'll see that as you age, you get to the point where your financial assets are going to cover all of your expenses. So if you die, those financial assets that you have accumulated, you no longer need. Okay, so there's a lot of people that when they hit kind of that retirement age and they have no longer any dependents under them, they actually won't necessarily need life insurance unless they want to use life insurance in a different way. And it's kind of beyond the scope of this class. Okay, so we talked about asset accumulation over the life cycle. We can also talk about our risk preference. So this idea of conservation and risk management. The second stage involves protecting and preserving the assets accumulated. So you may have accumulated assets and you're concerned that you might outlive those assets. And so you may want to buy life insurance to add to the existing amount of assets that you have. And as I've already mentioned a few moments ago, there is the ability or the desire to leave money as a gifting to a charity or to even relatives. And so that would be something that you want to have money for should you die prematurely. Okay. Okay. There are two main types of life insurance. There is going to be term insurance, and this is a truly pure insurance. All right. So you're going to pay for the aspect of I have a life insurance that's going to provide me a specified amount of money during the term. And the term is set. Typically, it's going to be from 1 year up to about 30 years. Okay, that's typical. All right. Permanent insurance, when you think of the word permanent, it is set, right? So that is going to be an insurance that is going to last your permanent life. Okay, obviously within making sure that you're making your premium payments. Okay, let's get this. All right, so let's go to our term insurance. This is probably one of the most common aspects of life insurance. It is going to be a death benefit that is paid during the coverage period. Okay, and like I mentioned on the previous slide, it's going to be anywhere from say 1 year up to 30 years. Okay, and it is going to be the most affordable. You are basically just paying for the fact that if you die during this period of time, the insurance company will provide the beneficiary with the proceeds. Okay. There's nothing fancy about term insurance. It is pretty basic, which is why it's typically the most affordable. Okay. And over here, you have level term insurance. The premiums remain level. Remember, the premiums are what you pay annually for the coverage. Okay. That's what you are going to pay for this insurance protection. All right. And those are going to stay the same, right? So if you do a 30-year life insurance, term life insurance, and the insurance agent is going to say, okay, you're going to pay, let's say it's $650 a month. I'm sorry, a year, or $25 a month for the next, say, 30 years. Well, it's going to stay flat. And we'll get into this later, I think. But the reality is that if you outlive the term, right? So let's say I'm 43. If I buy a 20-year policy, I'll be 63 when that policy is ending. If at 63 I need a new policy, the likelihood of me dying at 63 versus 43 is much higher. So therefore, my premiums are going to be much more expensive than they are now. Right. So we're going to have to balance this trade-off between affordability and the need maybe for permanent life insurance. Okay. All right. So what are the different factors that influence the premiums? Well, first of all, we're going to think about the length of coverage. Obviously, the longer coverage we are going to need, the higher the premium policy is. The older we are, the more expensive the insurance is going to be. How much coverage do we need? A $100,000 insurance policy is going to be different than a $500,000 insurance policy. Gender is a huge component when it comes to pricing life insurance. Males are typically they take more risks, and therefore their premiums are typically going to be higher. And then, of course, things that are going to be, and smoking and health conditions kind of fall a little bit together. Smoking status, and then, of course, your general health. Okay, so this is going to be things like, are you overweight? Do you exercise? Do you have good habits? Those types of things. Okay. All right. Now let's transition into permanent or cash value insurance. Now, the difference, as you keep seeing here, you keep seeing this idea of cash value. So, permanent insurance is basically going to be two components. We have the insurance component, plus we have a savings account. Okay. So, you're basically paying an amount of money that's going to cover both. Okay. It's going to provide you the insurance protection. Okay. And it's also going to provide you with some form of a savings component. And that savings component can be used for a variety of different reasons. All right. Now, what's nice is as long as you're making these payments, you won't be canceled. In other words, the insurance company will not just say, hey, you know what, you're past 65 years old, you're going to stop receiving this coverage. No, as long as you're making your payments, you're going to receive that coverage. And there are three main types of permanent policies. As you see here, there is whole life, universal life, and variable life. And we'll go through each one of those here. Okay, so we're going to start with whole life. All right. Whole life insurance provides a death benefit when the individual passes away, of course, providing for the beneficiaries. It does have fixed premiums over the duration of the policy. So this right here is kind of what makes whole life unique. It does offer cash value, and it's typically stated in the policy. And what I mean by stated is the return on the savings portion. Okay. And one of the other features is that it has a non-forfeiture right. Okay. The policy holders will benefit from a non-forfeiture right, which provides options to retain the value even if the premium payments are discontinued. So in other words, if I'm going to stop my payments and I have a whole life insurance policy, I have options as to what I'm going to do with this policy. Okay, so that was whole life. Now we're moving into universal life. And the key feature of universal life is really flexible premiums and flexible benefits. Okay, so what does this mean? Well, for flexible premiums, as I mentioned, in whole life, you have a fixed premium. Let's say it's $150 a month. In a universal life insurance, you actually have the ability to pay more than that. You have the ability to pay less than that. As long as there is an amount of cash, remember the savings of vehicle that's in these permanent policies, as long as there's enough money in there in the savings portion of the policy to make your premium payments or to cover the cost of insurance, then the policy will remain in effect. Okay. And the other thing about universal life insurance is not only is it the flexible premiums, but you also have sometimes flexible death benefits. You can actually go in there and say, you know what, I want to increase my death benefit from 250,000 to, let's say, 400,000. Now, of course, the insurance will go up and your payments will go up, but you have the ability to adjust your policy. That's what makes this universal life insurance attractive to a lot of people. The biggest issue, though, with universal life, I believe, is right here. Policyholders may not end up with the anticipated amount of savings. So when they give you an illustration, in other words, when they're showing you hey, this is what the policy we believe would entail. If you are not earning a return sufficient enough in that savings account to make the payments, then the policy could lapse if you're not making your payments. And if the returns are really low, you may have to continue to make more payments than what you thought you would have to make. So yes, it is flexible, but it's only flexible if you have a sufficient base already established in that policy. Okay, so that was universal. Now let's move on to variable. So here you have a little bit of flexible premium options. It allows for either fixed or flexible premiums. So it gives you a little bit of control. And the savings account is no longer just a kind of a fixed rate, but that variable gives you the option to invest in funds. Okay, so you can invest in mutual funds that provide maybe a substantial enhancement to the returns in this savings account inside the life insurance policy. And so because of that, that savings accounts can grow and then obviously be used to help make payments to your variable policy or even use it as a savings account for you later. Okay, so what's in life insurance? So just kind of taking a look at the differences between permanent and cash value. So again, term insurance, right, is going to be low cost, and it's primarily going to be the most commonly type of life insurance that most people will get. Okay. Cash value will have higher premiums, which again, because of that savings, that forced savings component, it has these higher premiums. Okay. And because the premiums are higher, you may be forced to get less coverage. All right. Main uses obviously would be things like paying, future premiums. You can also use it in a retirement supplement. That savings accounts can grow, and then you actually can take money out of that, perhaps even tax-free, for in retirement. Okay, so it just kind of gives you an illustration here. So for a 28-year-old male seeking a $250,000 of life insurance, the approximate cost would be, if they wanted whole life, they're going to look at $200 a month in premiums. And remember, this is insurance plus a savings account. Okay, that $200 is going to be fixed forever, as long as they live. So they could have this whole life policy for 45 years and it's going to stay fixed. Term, okay, so remember 28. So they're going to have this until they're 58 years old. It's going to be $20 a month. That's great. But what happens at 58 if they need more insurance? Well, it may go to another term when they are 58 years old, and that might be $300 a month. Because a 58-year-old is far more likely to die in a 20-year or 30-year period than a 28-year-old. Okay, so again, you need to make sure that you're balancing the trade-off between the premiums and the length of coverage that you need. So here's just a couple of different sites that you can go to. So insure.com and insweb.com are both websites that will help give you information on premiums and other insurance options. Okay. You can obviously do a quick search for insurance quotes. You can also go strictly to insurance carriers' websites, and a lot of times they can give you a generic quote. Okay. All right. So we have term insurance, we have permanent insurance, which consists of whole life, variable life, and universal life. Okay. Now we need to think about, well, okay, so I know what kind of insurance is available. How much insurance should I get? Okay. Well, there's a couple different ways to determine how much insurance you might need and to determine, and they're all going to provide you a different value. Okay. So this first one is fairly straightforward. We typically refer to it as the earnings multiple approach, which basically says, well, let's just take 10 to 20 times your annual income. So in this case, if you're making 40,000 at 10, you might make a $400,000 life insurance. Or if you make 40,000 times 20, it would be $800,000 in life insurance. Okay. So Maybe you just say, well, maybe I'll split the difference and do a $600,000 life insurance. But what's going to happen is you're just going to say to yourself, if I can put in to my account $600,000, can that $600,000 provide me perhaps a return pretty close to $40,000 for the rest of my life? Okay. And we can obviously run some calculations on that to determine the likelihood of that. We can also use a budget method. Okay. So this is really a needs-based approach. Okay. In other words, how much money do I need to be able to replace all of the different needs that I need to take into consideration? So, for example, I may need to eliminate some debt. I may need to have some dependency expenses, spousal lifetime income, educational expenses, retirement income. What I'm going to do is I'm going to take each one of these aspects of my life that I need to pay for, and I'm going to determine what the value of that is today. And in order to do that, we basically use our time value of money formulas. So we're basically just going to use time value of money, and we're going to figure what the value is of each one of these expenses. That's what they are. Okay, these are nothing more than expenses. Okay, I need to be able to pay for those, and I need to have the money in my account today to be able to make those payments should I not be working. All right, so let's give an example. So we meet Tom. He has 20 years left until his retirement. He currently earns $50,000 per year and wants to ensure that his partner is financially secure if he were to pass away before reaching retirement age. In this scenario, we need to determine how much life insurance Tom should purchase to replace his income for his partner. We'll make an important assumption. Tom's partner can earn a 7% return on investment in the market on the insurance payout that they would receive in the event of Tom's death. So Tom has a life insurance policy. Okay. He earns $50,000 a year. And if this life insurance policy pays out to his partner can invest the money at 7%. All right. That's where we are. The question we need to answer is, how much insurance does Tom need to buy to adequately replace his income for his partner? This example sets the stage for calculating the appropriate amount of life insurance coverage based on income replacement needs, considering factors such as years until retirement, current salary, and potential investment returns. And we're going to look at a few slides that show different values based on different aspects that we might change. Okay, so this first is going to be income replacement. All right, so income replacement, let's just use the quick rule of thumb that we're going to take $50,000 divided by our 7% rate of return, and it's going to yield us a $714,285 per year amount. In other words, if he was to have a we'll call it $715,000 in his account, and they can earn 7%, that 7% will pay out $50,000 every year, right? So the balance of the account will never change, okay? But perhaps that $715,000 coverage might be too expensive. So let's do it a little bit different way. Let's use our time value of money to solve for our present value using a 20-year. So we have 20 years, 7% interest, a $50,000 a year payment. And by the way, this should be in begin mode on our calculator. And the future value would be zero, right? In other words, we don't want money set aside. We don't want any money left over. If you do want money left over, we'll just replace this value with some number, okay? If we do this set of calculations, we come with a $530,000 life insurance policy. So this $530,000, if he had it in his account today, would be able to pay $50,000 a year for 20 years if we know that we can invest at 7%. That's what that does, all right? So now we can start to understand, well, how much life insurance do I really need? Is $50,000 going to be adequately enough to provide for the next 20 years, especially when we have high inflation, right? Well, let's say that I was able to not just get 7%, but let's say I was able to get 9% interest. Well, the great thing about that is it drastically reduces how much I need to have in life insurance coverage. Okay. So I went from 529, so 529, and I'm rounding this, of coverage to 456 in coverage, given a 9% rate of return. But remember, that's an annual rate of return. We have to make sure we get 9% for 20 years. Is that possible? Well, that's up to you. You have to start to determine this. So now we have a couple of different calculations. What if I need not just $50,000 a year? What if I want to replace $110,000 a year and I'm still able to get 9%? Okay. So I have my calculations here, and now I'm coming up with $1 million worth of life insurance coverage. In other words, I need to have $1 million to be able to make 20 years of payments of $110,000 if I can get 9% return. So again, time value of money. This is so important when we are thinking about why are we going to use time value of money? Well, we can determine how much life insurance we might need given these very basic parameters. Okay. Now, so you may determine how much you need, but you may not necessarily think, well, what happens if as I age, I'm going to continue to accumulate my own financial assets, so I don't need as much coverage as I begin to age? Well, what we can do is we can ladder policies. So we might have a policy where this is a 5 years, and this will come due in 10 years, and this is in 15 years, and this is in 20 years, and let's say this is 25. And we have a 250K, each one of these is 250K. Okay. So in 5 years, this one will mature and it will drop off, right? So that one goes away, but I still have $1 million of coverage, right? This would be $1 million. And for the next 5 years, let's say I'm continuing to save, this one drops off. And I don't need that one. So now I only have $750,000 in coverage. Okay. But again, I'm growing my asset base and I'm just laddering these out. So at the end of my 25 years, I don't have any life insurance coverage, but I've replaced that coverage with financial assets that I have. All right. So again, just another way to keep maybe costs lower because you're using term insurance. And this term insurance, remember, the longer your policy is, the more expensive. Well, this is only 5 years. So it may be a much lower policy in terms of its cost. Okay. Okay. So a couple of different aspects of life insurance that you might need to be aware of is the first is the non-forfeiture clause. Okay. So this is basically saying that as long as the premiums are being paid, the coverage will stay intact. Okay. So that's obviously very important. Incontestability clause. There was a period of time where insurance providers would have a claim come in, right? So if someone had been paying premiums for, let's say, 25 years, they would die. And then the insurance company would say, oh, you know what? This person didn't dot the I on their name. And so they misspelled their name, and therefore we're not going to pay out because it's a fraudulent application. They can't do that. After 2 years, the insurance company can no longer use, we'll call it misrepresentation of a policyholder on an application. So in other words, the insurance company has 2 years to evaluate whether or not there was any issues with the contract in order to void it. They can't do it after 2 years. Once the 2-year mark is in, the insurance company now basically is on the hook. Okay, renewability option. The feature allows you to renew your policy for another term once an existing policy expires. So if you have renewability in your contract, again, it allows you then to renew for another term. Okay. And typically it's so that you don't have to have a new application process. In some policies, there's a conversion option. This would allow you to convert your insurance policy into a whole life policy. In some cases, they'll do this for the first, let's say, 5 years of your, like, let's say you have a term policy and you're in 3 years and you're like, oh, you know what? I really think I need a whole life policy. They will allow you to convert that term policy into a whole life within that period of time. I don't think you can do it throughout the duration of the term policy, but in some cases you get like a window to be able to do that. Okay, different settlement options. I have a life insurance policy and I die. What are the beneficiaries' options? Okay, well, the first is they can get a lump sum payment. Okay, and this is probably one of the most common because obviously $1 today is worth more than $1 tomorrow. So most people want to get that money in full right away. But there are other, they're all installment payments. Okay, this would allow the beneficiary to receive an insurance payment regularly, whether that's once a month, once a quarter, once a year. Okay. Now, what's nice about this is this creates a spendthrift. There are some people that will receive a big inheritance through a life insurance, and then they go and spend it right away. Right? They buy a big house and they buy lots of cars, and in 2 or 3 years, they're kind of back to where they started because they didn't adequately prepare mentally for that emotional um, challenge of getting a windfall. So if you do installments, the insurance company will just pay you like you're receiving money out of a trust. All right. That may help you stay mindful of like, oh, look, I now can live off of this maybe $100,000 a year insurance policy payment. But I'm not receiving a $2 million life insurance proceeds in order to then just go spend it all. The other thing we need to keep in mind is the really critical piece of this is that the life insurance proceeds are in most cases tax free to the beneficiary. So if you receive life insurance proceeds, right? So let's say a grandparent dies and left you $100,000 life insurance, uh, a death benefit, you are going to receive that tax free. Okay, so again, that's really big that you don't have to then go and pay tax on that amount. All right. So how do we choose a company? Well, obviously, you want to find someone or a company that you can trust, and typically you should look for rating agencies. So there are agencies that will uh, evaluate the claims paying ability of an insurance provider. These are not government programs. The insurance companies, their ability to make good on their life insurance policies are that they have financial resources to be able to do that. These rating agencies help consumers to assess, are the companies likely to be able to make the payment should I need it? Okay. So you want to be able to look at rating agencies specifically on these life insurance companies. The other thing you can do is to reach out to an agent. Agents obviously are going to be working for you, and they're going to receive a commission from the insurance companies that they work for. But again, an agent, they're going to say, look, let's look at this company, or let's look at this insurance, Allstate, State Farm, Liberty Mutual. Let's look at these different companies and let's provide you the best option. That way, you don't have to go to the individual carriers. Okay. And again, they are solely working on your behalf. So just some different considerations. Remember, keep in mind when you are looking uh, at an agent, you want to probably look at both a independent agent, someone who's going to be able to shop for you, or you might look at it at an agent specifically focused on an individual carrier like State Farm. Okay, State Farm will sell State Farm policies. They can't go and sell Progressive policies. Okay. An insurance broker, though, can buy different policies from different companies. So you might just, consider looking at those different options. Make sure you understand that term policy does not have a savings component. Permanent policies do. Okay. Again, you wanted to make sure you understand what is your need for the life insurance in terms of coverage. And that was going to help you identify what type of insurance product that you need. Where are you in your life stage, right? So as you start out in your career, you might need just a very small amount. As you start to have a family, you might need a lot more. And as you start to then age into retirement, you don't need as much insurance. So make sure you know where you are in the life stage. Okay. Here is just a final slide on, where can you go to help make a purchase? Obviously, you can go online. There's a lot of different places that you can search for a quote. You can obviously call an insurance broker, or you can call the direct insurance company like State Farm or Liberty Mutual. Okay, I would encourage you, though, to not just take one quote. Every insurance company might provide you a different quote and different set of options. So make sure you're shopping around. And then here's just a couple of tools. There's a Voya life insurance calculator, money education, the textbooks that we use in the personal financial planning department. They actually have some life insurance calculators. New York Life, again, has some insurance calculators where you can type in your information and it will give you a kind of a ballpark recommendation as to what you might be looking for when it comes to understanding how much insurance you need. All right, everybody. Well, with that, we are wrapping up this life insurance piece. I know that's a lot of information, but hopefully it's going to help you think about when you start to graduate or when you graduate and you start to build out you have financial obligations that are due in the future. that you start to think about, well, if I can't make those, how am I going to cover those obligations? And life insurance is probably a good something to consider, especially as you're young. As you're young, life insurance typically is going to be the cheapest it will ever be. Every day you get older, you are one closer day to death. So insurance can start to increase. So just be aware of that. All right. Well, hopefully this was a good session for you, and we'll see you at the next one.